Coming up today, stocks start August sharply lower. A look at the earnings results from Apple and Amazon. Jobless claims rise to a one-year high. The 10-year falls below 4%. A preview of the jobs report tomorrow. And are we on the cusp of a full-scale war between Israel and Iran? Let's go, guys. And welcome back everybody to the channel. On a pretty sharp fall and increase on volatility. To start the month of August, which looking back in history, like I've been pointing out, we can see a bit of weakness. The month of August can quite often finish lower, and we can see that sharp change in the market color up the front. Plenty of red across the board. The only thing green across the board is gold and the defensive sectors of healthcare, staples and utilities. There was another massive rotation into defensive sectors today. Just looking at the main indices, we've got the S&P 500 off 1.4%. Nasdaq had another big down day, 2.4%, but it was small caps that performed the worst, down a huge 3.2% on volume, sending the VIX sharply higher, 18.5. And in fact, we got jobs report tomorrow and escalating geopolitical tensions in the Middle East. We got the VIX one day shooting up today to 24. In fact, that's the highest level it's ever closed at in its history of trading. This VIX one-day index just launched a little over a year ago by SIBO, and so option dealers are pricing in a bit of volatility tomorrow and going into the weekend. We got the VIX 9-day as well, sitting above the VIX, and volatility shooting up. Bond market volatility, not all that high. However, we are seeing an increase in oil market volatility and a little bit of a bump up in gold as well. Another nosedive, the government bond 2-year yield, now at 4.15, smack bang at the bottom of this big support zone from earlier in the year. And the 10-year taking out the psychologically important level of 4%. Currently at 398. I'll be really looking for this area around 385 to hold, because if the bond market takes that out, it could actually be pricing in a recession. But I'll get more into that later on, and the economic data that has caused these big moves, along with what we might see tomorrow, the big jobs report. For now, just looking at the price action, we did see a sharp reversal in high yield bonds as well, quickly coming back down off their yearly highs. The dollar's holding up above 104, and Bitcoin did a big buy the dip below the 50-day in today's session. I'll also be touching on later of the potential of Israel and Iran to go in a full-scale war, as Iran has vowed revenge on Israel for killing the leaders of Hamas and Hezbollah right within their own territory. So we'll come back to that later. We also saw semiconductor stocks do a massive U-turn again today, showing we are getting a bit of realized volatility here in the market. Down 3.8%. Yesterday they were up 7.6%. Today they're down 6.4%. Starting to trade like a penny stock here and testing this big support zone I've had drawn in for a week. And you know the market's pricing in the risk of war when you see airline jet sector sharply lower, 4.6%, trading down. And it wasn't a complete liquidation event across the market, because we did see the sectors of healthcare, consumer staples, REITs, and utilities actually finish the day higher. Utilities actually had a really good day, up 1.8% on volume. However, what has got the market moving after hours is the earnings out from Amazon, in which it fell about 7%. And we also heard from Apple as well, pretty much just held ground after it released its result. So it looks like it may have bought itself some time, even though we did see a decline in iPhone sales, coming in a touch lower from last year. They've still got struggles in China, competition from local brands, leading to a 6.5% decline in China iPhone sales. However, they did slightly beat Wall Street expectations. Overall profit for the quarter, $21.45 billion. 8% increase, and they did see sales increase in all regions outside of China. With the focus now on the launch of their new iPhone 16 coming next month, getting the street excited. They've also tagged over $100 billion to be spent on artificial intelligence, research and development. They're expecting more revenue growth on the back of the iPhone upgrade cycle. Services are still growing really good, 14%. iPad and Mac still doing well. There was a bit of a decline in wearables, home and accessories. So all in all, the result wasn't too bad. And in fact, just like I showed yesterday on Meta's revenue growth year over year, Apple is starting to form a similar pattern, maybe not as good, but this here is why we follow the technicals. As we know, the stock price in Apple's been doing really well for a few months and has front run this number that we got today. However, on the back of iPhone 16, very possible coming quarters, we may see 10, 15, who knows, even high teens for revenue growth once again for Apple. And the technicals are still holding up, still uptrending, holding onto its 50-day here. Of course, with some market weakness, we may come down and test this area here. However, at the end of the day, it was a beat on the top and bottom lines, and I'd say could be a good buy the dip candidate for a swing trade going into the iPhone 16 launch in September. That is if the market holds up overall. However, we're also hearing news that Berkshire Hathaway and Warren Buffett may be selling more Apple stock. And I'd say this isn't too big a reason for cause of concern. It's probably Buffett just taking advantage of elevated prices to trim what is still a massive position in his portfolio. I think a few months ago it reached 50% of his stock portfolio. And even though he likes to concentrate his best bets, I'd say he probably got a little uncomfortable with just how concentrated Apple is and how well it's performed over the last couple of years. So I still expect it to be the number one position in his portfolio for many years to come. He's probably just taking a few chips off the table while he can. We also just heard from Amazon. Revenue fell short of analyst expectations, 148 billion versus 148.7 billion expected. Earnings per share were $1.26, up a huge 94% from last year. Amazon Web Services, AWS, revenue 26.3 billion. That's a 19% increase. Ad revenue growing 20%, although the market didn't like a projected Q3 revenue of 154 to 158 billion, given some weaker guidance. CapEx up 58%, significant spending on AI infrastructure, data centers, and so overall the market was hoping for something a bit better from Amazon, and the price action we get in Amazon is a bit of a key indicator for the health of the US consumer, since a lot of it is discretionary spend. They service all segments of the market. We pay close attention to Amazon for keys on the health of the US economy. So I think we could draw a support box in, and how you want to draw support boxes is you want to include as many wicks in the candles as possible, and you want to give more weight to recent candles. So I think we can draw one in around this level here, and we'll just touch on that recent candle. So around 174, 175, which just going down to the 15-minute chart, it has just briefly dipped below in the last hour or two of the post-market session. So we'll see whether it can reclaim that tomorrow. Otherwise, if it were to take out that, the next area we'll be looking for support would be to defend its earnings gap from February, with the top end of that gap around 166 will be another area we'll be watching for support on Amazon, and could also potentially make a good buy the dip swing trade as well if the market is holding up. Wasn't good news for shareholders of Intel today. Reported adjusted earnings per share of 2 cents versus Wall Street's estimate of 10 cents. A huge missed on revenue as well. Gave a weak forecast. CEO came out and said going to have to cut 15,000 jobs. That's over 15% of its headcount. Suspended its dividend. Pretty much everything the algos don't want to hear, and that's why it got completely bushwhacked in the post-market session. Down a whopping 19%, and how the giants fall. This used to be the leading chip stock for decades, head and shoulders above NVDA. Now the move we saw in NVIDIA yesterday, 320 billion in market cap, it's almost 3 times the size of Intel's market cap in total. And I'd say that's lagging, probably closer to 100 billion by the time it opens tomorrow. Just a huge miss. However, for the here and now, investors, small and large, are still positioned in mega cap growth and tech stocks, in fact near historical extremes. But like I've been saying, we've got a lot of seasonal technical signs that we could see some more weakness and volatility. And another thing adding to that is the presidential election. Looking back in history, the VIX can often rise from where we are now going into that. So we could very well be in for a period where we see the VIX hover around 20 until the dust settles after the election. And that could be a very volatile one, because according to some prediction markets and mainstream media polls, apparently the two candidates are close to even odds at the moment. And so hopefully that all goes smoothly regardless of the outcomes. But us as investors, we have to prepare for whatever outcome we get and tweak our strategies going forward based on that. But just looking at the global macro, we did get a bit of a rise in jobless claims today, rising 14,000 to 249,000, the highest in almost a year, with the 4-week moving average at 238,000. And there's a look at the 1-year chart of the amount of people in the States filing for jobless claims, 249,000. And see, it's definitely uptrending. There is for sure softness in the US jobs market. However, just going out to a 3-year chart, still a bit below what we saw in the middle of last year. I'd say if we take out that 261,000 in the coming weeks, that could be significant. And I'd say this is why we're seeing bond yields pulling back, probably along with a bit of a flight to safety going into this weekend as well. So tomorrow could be a big day in the markets with the jobs report, waiting for Iran's response to Israel. We also got weak manufacturing data with the ISM manufacturing index sliding to an 8-month low of 46.8%, and the S&P global PMI also decreased into contraction territory, 49.6. So the good thing is we do have broad-based signs of disinflation. More than 50% of 74 CPI components are running below 2% year over year for 3 months now, showing that the breadth in inflation is definitely coming down. Still a real possibility we see a 70s style second wave. That's why I like having some exposure to commodities as a good hedge. But it will be interesting to see what we get tomorrow. With the July jobs report likely to show non-farm payrolls rising by 175,000, indicating a slowdown in job growth. Unemployment rates expected to come at 4.1%. So I think the best case for the market tomorrow is if we get that 4.1. If it comes in at 4%, the market might start getting worried whether the Fed can cut next month or not. However, if it rises to 4.2, that will trigger the SARM rule, which is a good predictor of recessions. Then the market might get worried of a recession and sell off. So we'll be looking for a print of 4.1 tomorrow as expected, and then we'll be closely monitoring the probabilities of the Fed rate cuts for for the rest of the year. Remember, the market's already pricing in more than 100% chance they're going to start cutting next month. And I'd say with risk markets coming off today and potentially more tomorrow, significant geopolitical risks, that soft manufacturing data, even if we came in at 4.1 tomorrow, I'd say we're still almost guaranteed a cut next month, and 110% if it comes in at 4.2 or higher. J-Power will definitely want to get in front of a significantly weakening jobs market. So that's what we're paying attention to. Economy is cooling a little bit. Jobs market is softening. We want that soft landing where it just cools a little bit, brings down inflation, the Fed can cut rates, and the good times for corporate profits in the stock market can continue. And if we get that and the US economy doesn't go into a recession, then we can look forward to some more gains. Looking back in history, S&P 500 will increase 15% 12 months after the first Fed rate cut if we don't get a recession. However, if we get a recession, we shouldn't be surprised to see stocks come off 15 or 20% in the following year and a half. Otherwise, if the economy holds up, businesses enjoy a lower cost of capital. Fixed income investors go hunting around for higher yielding assets. All that helps growth assets go up in price. Bond market, as often, can get in front of these things. Just looking back in history, the 10-year Treasury yield going into soft landing. In the dotted vertical line, the first cut of a soft landing, you can see yields drop for about 4 or 5 months going into that, like we are now. And then they'll fall a little bit after that first cut. Then they'll stabilize and grind sideways. And just after we saw Bank of Japan increase rates yesterday from 0.1% to 0.25%, we just saw the Bank of England today come out and lower their rate 5% in their first cut since 2020. Inflation hit the 2% target in May and June. Services inflation remains high. The governor did caution that the rate cut won't lead to rapid successive rate cuts. Investors are pricing in possibly 1 or 2 more rate cuts this year, with their 2-year bond yield now down to 3.69. So the central bank's really betting now that inflation is done. Hopefully we don't see upticks in CPI around the corner. Otherwise, they're going to have egg on their face. So over to Bitcoin, still a little soft here after the Bitcoin conference, Nashville, Tennessee. Quite often you see that. Buy the rumor, sell the news. However, like I said, it's really a bet on who's really going to win the election. And there's also still news getting around current administration is offloading a lot of Bitcoins, as maybe a weak Bitcoin going into the election may actually help them. If one side's arguing for Bitcoin and that's ripping into the election, could cause a lot more enthusiasm to vote for that side. However, for the here and now, the big event we'll be watching this weekend is how Iran is going to respond to Israel after they just took out the leader of Hamas along with some others from Hezbollah. And last time Israel did that, we saw Iran send 350 missiles back to Israel, but they were pretty much all shot down with the help of the West. And also importantly, if that happens again, there's news that Iran could potentially launch an even bigger attack than that from all fronts. And according to a military intelligence channel that I follow, Israel sent diplomatic back-channel messages to both Iran and Lebanon stating that they are willing to go to full-scale war if Iran, Hezbollah, and other Iranian-backed groups conduct a retaliatory response which causes significant damage and casualties in Israel. So that's the key right there. If they send another barrage of 350 rockets and Israel and the West is able to shoot them all down, maybe that'll be the end of it like last time. However, if Iran is able to inflict significant damage on Israel, I'm pretty sure they're not just going to sit there and take it. As you could think of this as a bit of a power struggle in the Middle East. Iran thinks of themselves as the top dog, and they openly state for the elimination of Israel and have done for many years. They don't accept Israel over there. And the thing you got to understand with these dictators, a lot of them are delusional. They're fed information by their inner circle that he wants to hear. And so he may not fully understand that he's already been beat if he wants to go full-scale war with Israel and the West. And so this could be an opportunity for Israel and the West to shut down Iran before they can launch a nuclear weapon like they're trying to develop. So instead of the US government just trying to pay them off and ask them politely to not build a nuclear weapon, maybe this is Israel's chance to wipe out their ability to launch one, along with taking out all of their leadership. If Iran does cause significant damage on Israel this weekend, because we do know the US is sending a lot of military assets over there as we speak. They are preparing for this. So far, at least 12 surface ships have been sent there in the region, ready to coordinate, defend, and assist Israel. And so there's the real possibility of a big showdown this weekend. However, like we've seen in the past, Iran's military capability and technologies is simply no match for Israel and the West. So the response on Iran could be swift, might be all said and done come Sunday night. But how does all that affect us investors? Well, gold is definitely pricing in some geopolitical risk. Possible Fed rate cuts is also helping. If we do see a large-scale event this weekend, we could see gold spike come Monday. Has been trading pretty strong this week already. Pretty much sitting at all-time highs as I speak, just below 2,500 an ounce. However, interestingly, didn't get much of a reaction out of crude oil. Actually finished lower today after we had a big jump up yesterday. Maybe the weak economic data we got, the PMIs, increasing jobless claims, maybe spooked things on the demand side a little bit here. However, also the reality is even in a full-scale attack, the flow of crude oil shouldn't be affected that much either. We'd have to see a full-blown regional Middle East war wage on for weeks and months for an actual disruption in the supply. And plus we've got the US now producing more than Russia, Iran, Saudi Arabia combined. So there's much less risk than back in the 70s when we saw the same thing with the Yom Kippur War. Several Arab countries attacked Israel. US came in for its defense. They declared an oil embargo, shot the price up of oil, helped to add to a lot of inflation back then. We don't really have that much of a risk this time around. And again, just another reason why the West should pursue a transition to clean and renewable energy. Then we don't need to keep sending our money over to the Middle East, which, like Iran does, finances a lot of terrorism activities in the region. So I'll be paying close attention to how those events unfold this weekend. If something big does happen, come back to the Click Capital channel, and I may upload a special video as it's happening to let all you guys know exactly what's going on out there. But for the here and now, I think the market's a bit more concerned with these PMIs coming in a bit weaker and jobless claims coming in a bit higher. But of course, the big one tomorrow, first up in the morning, jobs report with consensus 175,000 jobs created, 4.1% unemployment rate. And going into that, the market is giving zero probability rates will stay on hold next month. In fact, even pricing in 28% chance we'll get a 50 basis point cut next month as well, which is normally reserved for emergency measures. Last time we got a 50 basis point cut was in COVID and the GFC 2008. So for the here and now, just looking at E-mini futures, they are trading a bit heavy. Looks like China and Japan's off a lot today as well. There's the Nikkei taking a bit of a dive as I speak. So definitely a bit of a risk-off mood out there. That sharp rotation into defensives. Gold trading up, volatility perking up, jobs report, potential full-scale war in the Middle East. As investors, we should expect some more volatility over the coming days. And as always, we'll just have to see where all the chips fall and continue to follow the tape. Thanks very much for sticking with Click Capital, and I'll see you again this time tomorrow for what's no doubt going to be an important daily market review. Thanks very much, everybody.